Hey Apes, what's up? It's K-Ape. Yesterday, December 17th, the Nasdaq Composite took a significant hit, closing sharply lower as the tech sector faced a broad retreat. The Nasdaq Composite fell 1.81%, marking a fourth session of losses in the last 5. This decline was primarily fueled by renewed concerns over the AI bubble and high valuations in tech stocks. Here are several reasons. 1. The Oracle shock. Today was a day when the Oracle shock really swept through the market again. Oracle rained on our parade again. Oracle has been building AI data centers all over the US, especially for OpenAI. The deal is simple. Once they're finished, OpenAI gets to use them. But as you know, Oracle's debt ratio is incredibly high right now. They're building these centers by taking out massive loans and getting investments. One of their major partners is a firm called Blue Owl. And Blue Owl says, "We're out." These two have been working on several joint projects. One of them was a $10 billion 1 gigawatt data center in Michigan. But this time, Blue Owl stepped up and said, "You know what? We can't do this." Then, why did they back out? Well, Blue Owl doesn't use their own cash for this. They take out loans too. But rumors started spreading that Oracle's financial health is in bad shape. The CDS premiums, which measure a company's default risk, they've gone like to the moon, breaking past 150 basis points. This means the market sees an 11% chance of default within 5 years. That's a dangerous rating. 2. The chain reaction. Naturally, lenders started saying, "Look, Oracle might go under any time. That makes this project way more risky." They demanded much higher interest rates as compensation. But for Blue Owl, they aren't running a charity. If they borrow at such high rates, there's no profit left. So Blue Owl told Oracle, "Sorry, but we're out of this one." This has a huge impact. Since OpenAI was supposed to use that center, this delay means they can't secure enough capacity. And what does that mean? Fewer NVIDIA chips will be sold. This one project ripples through the entire AI ecosystem. That's why we saw AI stocks falling one after another today. Third, Wall Street's defense, some on Wall Street are pushing back. They say the Oracle case is just a rare exception. According to Goldman Sachs' analysis, we need to look at how funding will work over the next few years. Goldman says that out of the $1 trillion needed for investment, 90% will come from cash flow. Companies are using the money they've already earned, not just piling on debt. Only 10% is funded by debt. And a huge chunk of that comes from Meta, which has a better credit rating than the US government. So, companies like Oracle or CoreWeave only make up about 2 to 3% of the total debt market. Wall Street argues this is just a tail risk, and that the overall funding structure is actually quite healthy. Fourth. Lastly, Goldman Sachs released a very interesting report on Tesla yesterday. People were excited about Tesla testing unsupervised robotaxis in Austin, but Goldman calmly kept their neutral rating and a $400 price target. That's way below the current price. Goldman's Mark Delaney admitted that removing the safety drivers shows significant progress in Tesla's self-driving tech. However, here is where Goldman Sachs gets real. They say investors shouldn't just ask, "Is the tech possible?" anymore. Instead, they need to focus on how fast can they scale and is it actually profitable? With rivals like Waymo and Uber moving fast, Goldman worries Tesla's margins might be limited. On top of that, there's a big regulatory risk brewing in California. Authorities there have officially taken issue with Tesla's deceptive marketing, specifically claiming the term autopilot, or FSD, misleads customers into thinking the cars are fully autonomous. They've warned that if Tesla doesn't correct these advertising practices within 30 days, their license to sell vehicles in the state could be suspended. Losing the California market would be a massive blow to their bottom line. To be honest, the news about California's regulations on Tesla had already been out for 2 days. Even when Goldman Sachs released its opinion, Tesla's stock barely budged in the after-hours market. It was like the TSLA was saying, "So what?" Today's decline shouldn't be blamed on those two pieces of news. Rather, it should be seen as a result of the ongoing and deepening concerns over an AI bubble. 5. Make your own surprise. While everyone was worried about Oracle, Micron's earnings came out. They're saying like, "Man, we were good, everyone." revenue hit $13.6 billion, comfortably beating the $13 billion estimate. But the guidance was even better. Their operating profit also crushed expectations. Thanks to this impressive performance, the stock is currently surging over 8% in after-hours trading. Can Micron truly rescue a market currently gripped by the Oracle fear? Let's keep a close eye on the market today. This bumpy ride is likely to continue. US opens tonight. Think I'm jumping in on something. All my live trades go up around 8 to 9 a.m. Eastern in the community tab. That's it for today. Smash like and subscribe. Catch you on the next. K-Ape out. Thanks.